So welcome to this video. In this video, we are going to look at environmental management accounting. So this is a theory where we apply management accounting principles for the benefit of economic decisions, environmental decisions that a company has to take. So EMA, environmental management accounting, is concerned with the accounting information needs of managers in relation to the organization's activities that affect the environment as well as environment related impacts of the organization. So it involves the identification and estimation of the financial and non-financial costs of environmental related activities with a view to control and reduce these costs. So see, a company when it's being operated, it creates a lot of environmental cost. For example, pollution they might create, or waste they can create. Things like carbon dioxide emission, okay, so or water pollution they can create. So a company when it is being operated, it creates a lot of these kinds of pollution which affects the environment. So earlier this was not considered as a major element for a major headache for a company, because like consumers never cared for it and businesses also never cared for it. But now there are like so many environmental protection organizations which have come up, and consumers are becoming more and more aware. So these costs have, so companies are being pressurized to tell what are these costs and how they are incurred and how they are like planning to manage them. So the stakeholders like consumers and environmental organizations are putting much pressure on companies to show what is the total amount of pollution the company contributes and the total amount of cost it has, okay, for these things, and how they are going to prevent these kinds of pollution. Okay, so to prevent this kind of pollution, first of all we need to identify the pollution caused by the company, right? So how much of carbon dioxide they emit, that they have to first find out. Then they have to try to find out how to stop this pollution. Okay, to stop that they have to find out what is the cost which is already incurred because of this pollution, and then they have to stop it, okay, in terms of some machinery or in terms of some equipment. Okay, in some way they have to reduce the pollution here. So environmental costs is gaining much more popularity in nowadays, and companies have to focus on this. Okay, so this theory relates to environmental costs alone. So when we tell environmental cost, we usually tell it is like related to pollution, but it is we can like subdivide into like many categories. So first one is conventional cost. Okay, so conventional environmental cost is cost having an environmental impact, such as raw material and energy cost. So companies consume raw materials like plastics, okay, and this plastic becomes a waste later. And energy which is like consumed by the company, this energy is doesn't need to be produced, okay, if the company is not like producing the goods. So energy also creates a lot of pollution indirectly. So normal accounting will not take this and all into account. They will take the raw material cost, they will take energy cost, but what they don't take into account is what is the raw material kgs they have consumed and energy in kilowatts or something they have consumed. Okay, so traditional management accounting system would have hidden these within overheads. Okay, so these costs would have normally would be taken as total cost, okay, or variable cost, fixed cost. So it goes under those headings. It is not shown separately as a environmental cost or energy cost. So environmental accounting says that we have to show them separately, okay, so that it is better identified and can be better managed. The next one is called as contingent cost. So includes future complaints cost, such as clear up, remediation, when a site is decommissioned. For example, a company is like operating a factory. In India, you can operate a factory. If you cause a lot of pollution, don't worry, you can move away from that place. But in UK and US, it is not like that. If you are going to use a land for factory purpose, okay, they divide the land into two parts. One land is called as green field, that is like normal kind of a land, and the other one is called as a brown field, okay, industrial brown field. So brownfield. So if a particular factory is closed, okay, this would be brownfield industrial areas have to be converted into a normal residential area. So for that, companies have to pay up a fee because they have operated a factory there and it is like decommissioned or like closed. It is now like it cannot be used for any purpose. So they have to pay for the destruction of the factory also. So this destruction cost is not usually taken into account in normal management accounting or financial accounting, because it is a cost which is going to be incurred in future, and we don't know what is going to be the amount. Okay, so this is usually not taken into account. Okay, what we can maximum do is we can create a provision for it, and like in 20 years we are going to close down the factory, and this would be the remediation cost, like that you can take into account. So he says traditional management accounting systems would have focused on annual periods rather than the entire life of a project, and therefore managers will have overlooked these costs due to a focus on the short term. So uh, as managers are always usually focused only on the short term of things, they don't care about what is happening in the longer term. Okay, so these costs are again hidden only. Okay, so environmental management accounting only brings these costs into the picture. So the next one is relationship cost. So image costs such as the cost of producing environmental information for public reporting, including integrated reporting or sustainability reports. So you might see that in order to show that they are a good company, they have to prepare a lot of reports like sustainability report, environmental report, like that. So these preparation of these reports itself is a cost. Okay, so traditionally management accounting systems would not have adequately captured this cost information, meaning that managers were unaware of the existence of these costs or did not realize the extent of these costs. So there is a cost which is being spent, but companies assume that it is to be a normal annual report creation expense, but it is not like that, because the company is trying to maintain a good image because of the pollution they cause. So they are, this it's a hidden cost. So again they have to bring out this cost separately. The last one is reputational cost. Cost associated with failing to address environmental issues, for example lost sales due to brand damage. Okay, so for example there is like at one point, if you have seen the movie Blood Diamond. Okay, once this movie was launched, there was an immediate fall in the diamond sales. Okay, throughout the diamond industry, diamond sales fell down. So to boost up it again, okay, to boost up it again, the diamond industry brought a certification saying that these are good diamonds. Okay, I forgot the name of it. I think it's fair diamond or good diamond or something, or ethically sourced diamonds. Okay, so it is not like a blood diamond. So blood diamond is like a diamond sourced from a war area at a very low price. So this one is okay. The fair diamond is sourced from normal countries which are like in peace. From that they are buying at a fair price. Okay, so these, if a company is doing anything which is not good for the environment, or they are doing something causing a lot of pollution and they get caught for it publicly, then companies have to spend a lot of money for it. Okay, it is called as a reputational cost. So there are three methods in which we can identify, or we can identify the costs related to environmental accounting. So the first one is ABC, activity based costing. So we have already seen separately what is activity based costing, how to work out of activity based costing. So activity based costing, okay, it differs from a normal costing. So in a normal costing or traditional costing, what we do, we just find all the costs put together and call it as all costs are added and called overheads. Okay, see in ABC we have something called as a cost pool, where we add all the cost. So the cost pool is incurred because of some activity. That activity is called as cost driver. So then we assign each type of cost to the product. Okay, so these are the steps. So how is like ABC useful in environmental management accounting? Because we can easily pool the environmental related costs. Okay, then we can find out a driver. So the driver can be in terms of number of products. Okay, because of due to that it might have risen, or the kgs, the weight of the product. Okay, or the liters of the product, or the uh, or any other activity. Okay, any other activity. So it could have incurred because of these, and finally we can allocate the environmental cost, okay, to each product. So assume that we have a product A, we can allocate to that, or if we have product B, C, like that, we can easily allocate. Okay, we can easily allocate. So how does this allocation work? Okay, how does this allocation work? See, normally product A, B, C will have a cost, okay, which have a production cost. We don't need to take all the cost, we'll just take it as production cost. So production cost can be like 10, 30 and 20. Okay, so what normally we'll do is we'll add a profit and we'll sell, right? We'll add a profit and sell. So if you see, if this is going to be the production cost and this is going to be the selling price, so selling price is something like 20, 35 and 25. Okay, so what would be our profit? Our profit would here be 19, right? It would be 5 and 5. So this would be our profit, but we have not taken the environmental cost. Okay, we have not taken the environmental cost. So environmental cost we have to take, okay, and we have to allocate to the products. So our environmental cost could be something like 10 here, okay, 1 here and 1 here. So if you take the normal production cost like that, then the product A is the most profitable. But when you take environmental cost into account, your profit would be quite different. Okay, so here your environmental cost is 10, okay, or else we'll put it as 20, okay, because it's a highly polluting product. So the profit is actually -1. Here it is 4 and here it is 4. That is, product B and C are actually better products. B and C are better products, which have, so we have not taken into account environmental cost. That's why this seems to be quite profitable. But when we take into account, the profitability moves to loss. Okay, this can happen because some products can easily produce. For example, a company produces two products. One is a paper cup, and another one is a plastic cup. By nature, plastic cups are pollution oriented, so the cost they are going to incur, whether it's going to be reputational cost or some other cost, it is going to be higher, right? So we can't say that plastic cups are cheap just because their production cost is cheap. Their production cost is cheap, but the environmental damage that they create, reputational damage that they can create, is 20 per unit. So there's no profit at all. So if you work out like this, if you work out things like this, then the company will stop producing plastic cups, and because it is like highly costly, okay, when you take the environmental cost into account, so the company will slowly move towards producing paper cups, which is ultimately beneficial for the entire society. Okay, so this is about your about your ABC costing. Okay, so we will just read ABC. So environmental related costs can be analyzed into costs which can be attributed directly to a cost center. For example, a waste filtration plant. Okay, it should be relatively straightforward to identify and to some extent control these costs. So, for example, a particular cost center, okay, or is incurring a particular environmental expense, something like a waste filtration. We can easily allocate that. Okay, it's like easily you can do it, but environmental driven costs which are generally hidden overheads. Okay, there are many costs which are hidden overheads, such as conventional costs. ABC will aim to separately identify these costs and control these costs. So that's what we have shown it here. Okay, the costs are removed from general overheads and traced to individual environmental cost pools for the product or service. See, we have not done that here, okay, because it quite complex, makes the problem quite complex. But in a lengthy problem, you can get an idea how this works. Okay. So this means that cost drivers are determined for these costs and products are charged for the use of these environmental costs based on the amount of cost drivers that they contribute to the activity. So that is what we have done. So this product increases the environmental cost a lot. These products don't do that. So that's what we have allocated it. This should result in a more realistic product cost. So the realistic product cost and the product profitability is here. This should also result in better control of environment related costs by reducing the incidental cost drivers and eliminating certain activities. So from here what happens is the company should focus on how to reduce the environmental cost. Okay, how to maximum reduce it. So the maximum, if they keep on reducing it, this product can become profitable. For example, if they are reducing the environmental related cost to 15, if they could do it from 20, the profit would go to 4. Okay, so it's only up to them to do it. So it helps the company to find out uh, what is the cost driver pushing this cost, that we can find out. We can reduce the cost driver, or we can reduce the total cost. Okay, the cost or the cost driver we can reduce. So finally it will lead to a reduction in environmental related cost. Okay, so we will take these a little bit lower, and we can we'll put an idea here. Start discussing about life cycle costing in relation to environmental management accounting. We have already seen like what is a life cycle costing here, but we'll see in relation to this. So traditional techniques based around annual periods may give a misleading impression of the cost and profitability of a product. Life cycle costing considers the cost and revenues of a product over its whole life rather than one accounting period. Therefore, the full cost of producing a product over its whole life will be taken into account. These costs include costs incurred prior to, during, and after the production, and will therefore include the full environmental cost of producing a product over its whole life cycle. So, normally life cycle cost includes, okay, normal costing includes only the production cost, okay, production, distribution, selling. I think we'll put like this, or selling. It includes these costs only. So these are like normal costs, but there are costs which are before producing also. So something like R&D cost, research and development cost, and there are also costs which are incurred after selling. For example, in terms of environmental, it can be decommissioning cost. There are some decommissioning costs which are involved after the product is produced and the factory is closed. Okay, so companies usually don't take the R&D cost into account and decommissioning cost into account. They only take the middle part of the cost into account while pricing a product. Okay, so this is not a right approach, because it might be assume the product is being like produced for 10 years. Okay, and on the 11th year this decommissioning cost is going to be incurred. Okay, and for 10 years each year the company is earning around some 10,000, we'll put. So the company will earn 1 lakh over its life, but and that's a profitability. Okay, that's a profitability. But at the end of the life of the project, what happens is the decommissioning cost alone, assume that it's going to be 50,000. So the company might have thought that they have earned a good profit, but the profit of like 1 lakh, but they have to pay at the end 50,000. So this becomes a huge cost. Okay, so their overall profitability with that product or with that factory would be only 50,000. Okay, so a company should not be only thinking about the production, distribution, and selling cost, okay, or the operational cost. They also have to think about the cost which is incurred prior, something like R&D cost and decommissioning cost. They have to think about. Okay, so life cycle costing helps that. It helps in terms of the end of the life cost and prior to the Okay, prior to production cost also it takes into account. So life cycle costing is a very nice approach. So the last one is flow cost accounting. So we'll discuss that. So what is flow cost accounting? See, normally companies have a production stage. Okay, so they have process A. Okay, we'll simply take it as process A, and then the product moves to process B and C, right? So some companies, if you take, they normally take into account the costs. Okay, what cost they take into account here is they take production costs into account. Okay, what is the production? They take production cost into account. For example, it's 100 rupees here, 200 rupees here, 100 rupees here, like that they take into account. Okay, see, this is not much useful because it is useful in the terms only like for financial accounting purpose. It's useful for financial accounting purpose to find out the profitability of a product. Okay, so to find out the profit of the company, it's useful. So apart from that, is there anything else? See, we can also try to find out waste. Okay, what is a waste? So waste is the total amount of products which are not useful for sale. Okay, that can be like $10. See, all these are dollars only. Okay, all these are represented in dollars. So we'll, okay, so this is represented in dollars, and this is also represented in dollars. Okay, so 10 here is some 15, and last year is 10. So they will find out that the total production cost was about these numbers. This is the total production cost. This is the total waste. See, again, this is useful only for the purpose of financial accounting, right? It's only useful for the purpose of financial accounting. For profit sake, it might be useful. So the flow cost accounting, okay, if you take flow cost accounting as a concept, it takes a lot of things into account. Okay, for example, it takes the energy energy cost into account. So it finds out what is the cost which is involved within this production cost, but separately shows it as an energy cost. So that could be 10, here it could be 20, here it could be 25. Okay, so we are not only concerned about the production cost, but also we are splitting into energy cost. It also takes into account the material cost, the material cost into account. So that can be some 20, so 25, some 10. So see, normally production cost will include this. Okay, but they want to show it separately. That's what flow cost accounting tells. And also they show both of this in terms, okay, in terms of uh, the absolute value. For example, this is called as kilowatt hours, and this is measured in kgs. Okay, so this can be like 15 kilowatts or 12 kilowatts. I'm not sure like what is kilowatts. Kilowatts is the consumption of power. Material is 10 kg, some 20 kg, and some 5 kg. We'll take it like that. Okay, so look at here. First, the company is only focused on production costs. Okay, and in recent times they started to focus on waste also, but that's also for financial purpose only they did. But now they are splitting all the costs and they are showing it in different kinds of uh, categories here. Okay, so now the waste, if there's going to be any waste, the waste is also split in the same kind of split. Okay, even the waste is split. So we are not only taking the waste into the cost, okay, in terms of we produce a product. Okay, the product gets not up to the customer's view. Okay. Now, how much of energy cost we have wasted, material we have wasted, energy we have wasted, okay, and how much of material in terms of kgs we have wasted. Okay, so you will get all these items in a split. So this helps you to find out which product is costing a lot of wastage, which one is incurring a lot of energy cost and energy, which one we have to first to focus. Okay, it's not that we have to focus. See, normally if you take to reduce the production cost, we'll focus on B, right? To reduce waste, we'll focus on again B only. But look at the energy. In terms of energy, we should reduce the waste in terms of C only, because C is the one which is causing a lot of uh, uh, wastage in terms of energy. In terms of kilograms wasted, it is process B. So if you want to reduce the energy consumed, you should focus on C. If you want to reduce the material consumed, you have to focus on C. So can you get the idea here? We are not only like trying to reduce the cost of the product by minimizing the wastage, we are trying to find out which product produces most wastage, okay, and which, and a detailed breakup is given here. Okay, the concept is a detailed breakup is given. So we'll read the flow cost accounting here. So flow cost accounting looks at material flows and material losses incurred at various stages of the production process. It makes the flow of materials much more transparent, and by doing so it aims to reduce the quantities of materials, leading to increased ecological efficacy, okay, sorry, efficiency. There are similarities between FCA and another technique called as input output analysis, which focuses on waste alone. Okay, so see, this is like input output analysis, how much you have input and how much it is getting wasted. Okay, for example, input and output, I can put it here and show you. So input output analysis, it takes the waste only into account, but it takes only the kgs into account. It takes only the kgs into account. Something like waste kgs, I think we had it here. Okay, not in terms of material. I think in terms of material, we'll just copy this. So this alone it will show. Okay, so this is called as input output analysis. Input output analysis. But our consideration is the flow cost accounting. So the flow cost accounting starts from here. Okay, hope you guys got a good idea about the theory here. So we can move on to a case and see a better idea about environmental management accounting. So this question was asked in December 2014 under this concept EMA. So we'll read the required first and see what has to be done. So this is the required. It tells, using Maxwell's stated environmental goals, assess the proposed investment plans 1A and 2. Okay, so the company has already stated an environmental goal. Okay, whether the 1A and 2 will help to achieve this or not, you have to tell. So that is 10 marks. Second one is explain, giving examples how traditional accounting systems are unable to deal adequately with environmental costs. So this is a theory question. I think we have discussed the theory earlier. That theory you can write here. Okay, why traditional costing systems are unable to capture it? Because the answer for the B1 is this. Okay, they are unable to capture it because these headings. Okay, conventional cost, contingent, relationship, and reputation. Okay, so what he's asking is actually this part. Okay, why the financial accounting or traditional management accounting is unable to capture it. Okay, so you can actually write it through headings. I think that would give you a better structure for your answer. Last one is discuss the life cycle costing issues associated with plan 2. So they are asking to apply life cycle costing to plan 2. So first we'll start with this one. First we'll find out what is the environmental goal, and second we'll find out whether 1A and 2 helps in achieving that goal or not. So we'll read the question here. So Maxwell Electricity Generation is an electricity generating firm producing power for industry and general public in the country of Deland. In the past, the company has dominated by the need to make suitable returns on capital for its shareholders. All power stations work in broadly the same way by taking in fuel, okay, whether it's coal, gas, or nuclear, and producing electricity and waste products. So Maxwell has the following mix of power stations. Okay, so this company has the following power stations. They have given power station type, details of each type of power station, and the total for Maxwell. So each type of power station, so we have like coal, gas, and nuclear. And coal is small and large, gas is again small and large. The maximum power generating capacity of each of this plant, okay, each of this plant. So see, that's why he tells each, okay. So one coal small power generating unit will produce 300 megawatts, like that he has put. He has also put operating cost of electricity. So for each station, this is the operating cost, and this is the capital cost. So to construct one any type of power generating unit, it will cost this much. So how much of total are available? So they have 4 small coal powers, 4 large ones, 8 small gases, and 2 large gas plants and 2 nuclear they have. So this is the total invested capital and total emissions also they have given in terms of tons. Okay. So the question itself is a big information we are getting. So maximum power generating power is the output of the station measured in megawatts at 100% operating capacity. The electricity produced by a station is measured in terms of megawatt hours. So I think that and all is not a problem. It is assumed that the same load factor applies across all the different types of station. I think again this seems to be something like engineering. We don't need to understand what is load factor and all. Operating cost of electricity is the cost before the cost of financing the capital invested in a situation. So these are operating costs only. They don't take into the financial costs. The carbon dioxide emissions are estimated based on industry standard figures for similar stations. Okay, so that is also they have given. Capital cost and CO2 emission figures are based on best estimates here. Okay, so I think all these notes are very not much useful for any working out a sum or discussing a problem. So the business has 2 alternative plans, 1A, 1B, to maintain current generating capacity, while 2 will grow the business. Okay, will grow the business. So 1A and 1B are only maintaining the same power. Okay, so we'll start from plan 1A. So plan 1A is to build a new nuclear power station. Okay, so we'll put it first. Take that into account. 1A. Build a new nuclear power station, the same as the existing only, to replace one of the 300 megawatt coal. Okay, so this is new one. So this is going to close. Okay, what's going to get closed is a coal station of 300 megawatt. I think that is small. We'll just check. Yes, coal small is 300. Gas small is also 300. Okay, so 300 small, I think they are going to close, and they are also going to close one of the 600 megawatt. So that is going to be coal big plant. So in terms of megawatt, this is 300, this is 600, and also one of the 300 megawatt gas station. So they're also going to close a gas I think that should be a small one only. So that comes to so we'll just look at here. So they're going to close these, right? We'll just like copy it and we'll just like cross verify it here. So they're going to close a small one of 300, a big one. Okay, I think we have to put the word large there. Okay, a large one at 600, coal gas small 300. So put together these comes to 1200. So these 1200 would be replaced by the nuclear power plant. Okay, so that's our plan 1A. The stations being replaced are all reaching the end of their useful life, so they are useless here onwards. So what about the next plan? The next plan is 1B. Sorry, it's 1B. Replace the gas and coal stations mentioned in 1A with equivalent gas and coal stations, thus meeting the current generating mix. So what we are going to do is we are going to close all these, right? And we are going to open a similar same things. Okay, we are not going to do any differently. We are going to similarly open the same things. Okay, so replace the gas and coal stations mentioned in 1A with equivalent gas and coal stations, thus meeting the current generating mix. And last one is in order to grow the business, so that's the plan 2. So plan 2 is in order to grow the business, a new nuclear power station is being considered as a combination with one of 1A or B, 1B. This nuclear station would be the same as the existing one. So plan 2 is nothing new. What they want is to open a nuclear power plant, but this is additional. They're not going to close anything, they're just going to open it. Okay. So this is a plan. So what is that we have to do in this sum? Maxwell is trying to raise finance for either plan 1A or 1B. In addition to one of these plans, plan 2. Okay, so 1A or 1B is either. Plan 2 is compulsory. A nuclear plant takes about 5 years to build, assuming no regulatory difficulties or problems over the design choice. It has a working life of 40 years and costs are about 1 billion at current price to decommission, although this estimate is uncertain as each site is unique in the decommissioning difficulties which it presents. So we have to take this 1 billion also into account. Okay, it has 40 years of life. So if you take 1 billion divided by 40 years, each year you can add this something like a depreciation cost, okay, or something like a provision. So this cost also has to be added with the nuclear. So let's see the last paragraph. We have come to the almost, no, we have still a lot of paragraphs, sorry. The government of D-Land has joined the international community in pledging to have greater concern for the environment. Initially, it has stated that there is a national goal to reduce carbon dioxide emissions by 20%. Okay, so the governments stated so the government stated objective are these. Okay, in terms of CO2 emission, in terms of CO2 emission, reduce by 20%. That is their one goal. The government is aware that electricity demand is expected to rise by around 10% over the next 5 years. Nevertheless, it is strongly encouraging a business to help achieve this reduction in CO2. emissions. So they also have to growth that is a proposal to raise a carbon tax, okay, on CO2 emissions in order to encourage reductions. The government is also concerned that there are other pollutants emitted by power stations, but has decided to focus on CO2 initially, as it is a cause of climate change. In order to join the wider community in achieving these aims, and as one of the major electricity generators in D-land, Maxwell has stated its own environmental goals. Okay, so the company also has some goals. Okay, what are that? To help reach national targets for reduction in CO2 emission. So that is what here we have already mentioned, while maintaining our ability to contribute to the electricity needs of the people of D-land. So that is what is given here. Okay, both goals are stated here. The finance director is interested in broadening environmental reporting within the company and has asked you, as a performance measurement expert, to explain some of the limitations of traditional accounting systems in dealing with environmental costs and to look at introducing environmental life cycle costing. Okay, so I think this would be reflected in the question itself. So we don't need to study it separately. We'll just find out whether these two objectives are achieved by 1A and 2. Okay, 1A and 2, whether they are being achieved or not. See, for 1B we don't need to do, because like 1B is only the same uh, uh, things are closed and again the same power generation is like created. We have to only look at the 1A and 2. So we'll take all this, or we'll cut all this. So we have got it. So 1B is not at all in our question, so we can remove it. The stated objects are very important, so we have to take them into consideration. Okay, so we'll start. See, so CO2 emission, we have to find out what it is currently there. Okay, so CO2 emission is like important, and we are also bothered about the total energy. Okay, so total energy, I think total energy we can do it later. We'll first start with the CO2 emission. Okay, so CO2 emission in terms of a 300 coal small plant. Okay, the emission is, see, it is 3.15 for all the four plants. Okay, it is 3.15 for all the four plants. So what is the emission per plant? So emission per plant is this. We'll do it for again for coal big. So we'll find out what is the for gas small. So gas small is again, see, I think gas small is 8. So there are 8 plants there. So there are 3.5 is the total emission and 8 is the, for per plant we'll find out. So we got this total emission. Okay. So what is the emission for nuclear? Nuclear emission is 0.5 divided by 2 plants are there. Okay, so we can find out the reduction in CO2 will be so the sum of all these, the existing emission minus the new emission. Okay, so we can easily reduce 4.0835. Okay, the target is to reduce the emission by 20%. So what is the total existing emission? Okay, what's the total existing emission? That has to fall. So the total existing emission is, it's already there. It is 26.51. So that is given here. Total revised emission is going to be a different number. So see, from we are going to close this plant, so emission is reduced. We are opening a new plant, emission is increased, but overall we are reducing this amount of emissions is reduced. Okay, so already produced is 26.51. From that, because of closing the old ones and opening a new nuclear one, we are going to reduce the emission. So the total reduced emission would be this number. Okay, so if you want, I think we'll put it like this. Okay, would be 22.41. So what is the percentage of reduction? So percentage of reduction in terms of percentage, you can put like this: 4.08 divided by the existing one is 2651.51 into 100. See whether it is like going to 80%. If it goes to 80%, it is good. See, it is reducing by 15%. At least 15% reduction is there. Okay, so they wanted to reduce it by 20%. That is not getting reduced. At least 15% it is getting reduced. So we can put like this: suggestion plan 1A will not achieve the target of 20% reduction in CO2 emission and also will not increase the energy production. See, that also will not be increased. So that is it is a useless thing. Okay, so we'll see the question about the 2. So at least plan 2 will do any good. Okay, that is what we want. Will plan 2 do any good? See, plan 2 will not will not do you much good, but we have to work it out and just find it out. So in terms of see, open nuclear of 1200 here. Emission is this. So emission per plant is going to be 0.25. Okay. So we don't need to much think about what is going to happen. Look here, they are going to open a nuclear plant. It will increase the emission. So we can actually work out it from here. See, there is already an emission. So there will be only an additional emission, right? So it will only be 26.51 plus the new plant emission is 0.25. So put together, it will only be 2.76. So emission is going to increase. Okay, emissions is going to increase. So emission is going to increase here. And what about the total power? Okay, see, total energy production will be, or existing total energy production is, I think we have to find out, because we don't have that number so quickly. So we have to find out. And how will we find it out? We will find out here. Okay, so I think first we have found out the emissions. Okay, now we will try to find out another table for plant 2 in terms of the megawatt. Okay, and number of plants, number of stations, and total power. Okay, so nuclear is here, big is 900. Okay, so done. So number of stations we have to type. It is 44822. So what is the total power? Total power would be this megawatt into this number of this number. So this is the total power generated currently crores. Yada? Okay, 10,200 is the total power which is being generated currently. Okay, now what is the additional power generated? The additional power generated is equal to 1,200 of nuclear. Okay, they're going to produce it. So will it achieve? So what is the percentage? Sorry, what's the percentage of power of new power generated? That's going to be 1,200 divided by the already existing power into 100. So that's going to be 11%. Okay, that's 11%. So what is our suggestion? Our suggestion is plan 2 will not achieve the target of 20% reduction in CO2, but will decrease the energy. Okay, sorry, but will increase the energy production. Okay, so one goal is achieved, one goal is not achieved. So the question is not asking us to combine both 1A and 2. Okay, that they are not asking. But if they combine 1A and 2, I think total power would be like achieved. That is like clearly visible. But the reduction in CO2 emission, that will never be achieved, because here it is already only 15% is reduced. The target was 20%. If we add one more plant in plant 2, again that is not going to help a lot. Okay, that's going to increase the small wise, it is going to increase the emission. So either way you look, it is not going to achieve both the targets. Okay, both the plants put together also will not achieve the targets. Okay, so that's about this question. We just have to look at from management accounting angle. So however a sum comes in management accounting, you should be able to crack it, because these are just like common sense numbers, common sense workings. Okay, so there's no any new methodology or anything to be solved. Okay, so there's no new technique or anything that we are using to solve it. So you should be able to crack it much easy itself. Okay, so hope you guys got a good idea with this case. I'll just like put the questions in perspective. Okay, so that's about the question and the answer. We have one more problem in environmental accounting, and I think we'll see that and we'll move. So